Good morning. This is Bloomberg Daybreak Europe. I'm Lizzy Burden in London, and these are the stories that set your agenda. Asian stocks start the week with gains, while European futures trade broadly flat as traders stand by for Wednesday's data on US inflation. Israel says it's pulling some troops from southern Gaza ahead of a planned offensive in Rafah. The oil rally takes a breather. Plus, US Treasury Secretary Janet Yellen meets the PBOC governor on her final day in China as she aims to put relations with Beijing on a firmer footing. A very good morning. Happy Monday. I hope you had a restful weekend. We have got a lot of geopolitics to get through and a busy week ahead for central banks. But let's just take you back to that blowout US jobs report on Friday. Markets essentially concluding that the US economy is going to power corporate America, even if it means that rates stay higher for longer. Now, overall last week might have been the S&P's worst since January, but that strong Friday session has powered Asian equities higher this morning, although you are looking at Wall Street futures pointing to a lower opening this morning, even if Europe is going to eke out some gains, it appears, at the moment. If we flip over to the cross-asset picture, you can see the difference when it comes to treasuries from that US jobs report in terms of Fed cut bets. Pared back to about 65 basis points this year now, treasuries have off the back ticked lower and the two-year yield is currently higher a touch. The dollar also a touch stronger as we look ahead to that US inflation report on Wednesday. Oil has been lower off the back of Israel saying that it's going to pull some troops out of Gaza. And Bitcoin is back below that 70K mark, having broken through it over the weekend. But let's zoom in on Asia markets now. Tanya Chen's waiting for us in Hong Kong. Tanya, what's happening where you are?
Good morning, Lizzy. Yes, as you were just saying, Asian stocks are starting the week a little bit on a bright spot after that better than expected U.S. jobs report that we saw. And as you aptly pointed out, it's not really so much the same sentiment in the mainland and the Hong Kong shares. The sentiment there just a little bit more poor, given that we've seen the Shimao, one of the defaulted Chinese developers that we've been tracking, facing a demand to liquidate. These winding up petitions are really starting to pile on. We've seen it also with Country Garden as well. I also wanted to take you into the commodities space a little bit. Iron ore rebounding a bit there after this long weekend that we had in China. Also in gold is also extending gains there. One thing to note is that China and Indian central banks, being big buyers of gold, has really been fueling this kind of scorching hot all-time record rally. And China has actually been buying gold for about 17 months straight. And then also kind of the big story out of China with the currency today has also been quite top of mind for traders. Earlier today, we saw the PBOC fix the yuan basically sub 7.1, a level they've been kind of leaving the fix at for several weeks and months. And what we've been tracking basically is what the onshore rate is doing around this 2% trading band, around this reference rate. And we see right now that it's about 20 pips away from kind of that weak end of the trading band. And in previous episodes, we've seen that the policymakers have really stepped in when you can feel the depreciation pressure really building in the onshore rate. At this point right now, analysts are saying that there is a possibility if the dollar continues to persist, PBOC may have to loosen that fixing to just let a little bit of breathing room into that onshore spot rate. So no forceful measures yet, but we're still tracking the yuan every day.
OK, Tanya Chen in Hong Kong, thank you for that. Interesting that you point out that the gold moves could be partly to do with China, not all about the Fed story. But let's talk about US-China relations now. US Treasury Secretary Janet Yellen, of course, still in China, due to hold a news conference later this morning as she wraps up that trip. Now, it's after talks that the PBOC governor had with her. She says they helped relations between Washington and Beijing reach a more stable footing.
As the world's two largest economies, we have a duty to our own countries and to the world to responsibly manage our complex relationship and to cooperate and show leadership on addressing pressing global challenges.
Well, for more on the trip, we've got Bloomberg's Jill Desis. Morning, Jill. It looks like Yellen's had a delightful weekend cruising down the Pearl River with the Vice Premier. Do you reckon that the conversations on board were as delightful?
Yes, well, Lizzie, it does seem like Janet Yellen is really Washington's good cop in this entire situation in the U.S.-China relationship. And while she did spend her trip criticizing China over some issues, particularly overcapacity, this idea of importing cheap goods to the rest of the world, a lot of her worries about that. Generally, it seems like it's been a pretty pleasant trip for her. This is, of course, her second trip in 9 months, and also likely her last as Treasury Secretary before the U.S. General elections later this year. But it generally has seemed like it's been pretty diplomatic. We'll obviously get more details from Janet Yellen once we have that press conference in just a couple of hours. But yes, ultimately, I think she's kind of served the purpose of smoothing over ties. It seems like there's been something of a decent response too from Beijing on that front.
Yeah, can you expand on what China's reaction's been? Because she's been chiding Chinese overcapacity. Surely they can't take that lightly.
No, well, certainly in state media they haven't. So it's, I think, where we've really seen the biggest points of criticism. So Xinhua, the official news agency for China, was kind of blasting Yellen over some of those overcapacity comments. I think also really criticizing the U.S. and saying, well, what about U.S. subsidies for things like semiconductors and things like that? So I think that's really where you're seeing the most pushback from a lot of officials she's been meeting with. You're getting more of this idea that the U.S. and China really need to strengthen cooperation across different things, but we haven't really seen yet that really big fulsome response. I will caution you, though, Lizzie. Look, China is also just coming off of a 4-day holiday period, so I think we'll get some resumption of the Ministry of Foreign Affairs. We'll see if there's a stronger reaction out of Beijing in the wake of this extended weekend that they've just had as well.
OK, Bloomberg's Jill Desis, we thank you for that update on Yellen's visit, and we look ahead to the press conference in the next couple of hours. But let's get to the Middle East now, where Israel's pulling some troops out of southern Gaza as the war with Hamas passes the 6-month mark. US Senator Chris Coons says the move is likely a tactical decision in case Hezbollah or Iran attack. We can now bring in Bloomberg's EMEA News Director Rosalind Matheson for analysis. Ros, what's behind this move, and does it affect a potential offensive in Rafah?
Well, it's probably multiple things that are behind this move. One is that they've been fighting now in Gaza for the better part of 6 months, and they need to rest and rotate some of their troops. So there's probably some truth in that. There's also the reality they need to reinforce their troops in the north of Israel because, of course, that's where Hezbollah tends to attack from Lebanon. That's the other Iranian-backed group that's operating in the region. In the aftermath of that airstrike on the Iranian diplomatic compound in Syria, there's been repeated warnings from Iran of some kind of retaliation, and that might likely come from one of their proxies, particularly Hezbollah again. So there's a possibility of stepped-up activity in that area, so you need troops back there. There's also pulling them back out of Khan Yunis because they want to be able to move Palestinians into that area for an offensive in Rafah. So none of this suggests that the desire to go in to have that offensive in Rafah has dissipated. This is not a withdrawal because of some other reason. It's just purely tactical on the part of Israel.
It's not a withdrawal, it's taking a break to come back for more. So what might Iranian retaliation look like for that strike on the diplomatic compound?
Well, quite possibly through those proxies. It would be really unusual and obviously a really big escalation for them to attack Israel directly, say to fire missiles directly to a major centre in Israel. That's really basically unprecedented. So what you might see really is that kind of proxy activity primarily through Hezbollah, from Lebanon, possibly again urging the Houthis on in the Red Sea. Of course, they've been blocking shipping in the Red Sea for months now, maybe some of that. But really, you can see through the back-channeling that's going on between the US and Iran. They're actually talking about the fact they're actually talking to each other, which again is unusual, shows that really Iran and the US, despite all of this, neither of them really want a direct conflict to happen. So we'll probably see something a little bit more asymmetric that Iran's known for.
OK, EMEA News Director Rosalind Matheson, we thank you. Of course, we've also had more of the back-channeling in the UK as well. The UK talking tough over the weekend when it comes to the situation in Gaza as well. But let's get back to the economic data now, because, of course, we've got the US CPI number coming out on Wednesday, a big focus for the Fed. It arrives hot on the heels of Friday's surprisingly strong US jobs numbers, and the data is projected to show a modest slowdown in underlying inflation. For more, we can bring in Dan Moss from Bloomberg Opinion. Dan, we had Jerome Powell saying that strong hiring on its own isn't going to be enough to delay policy easing, but this was a blowout jobs report we got on Friday. Do you think any Fed officials now will still be calling for 3 cuts this year?
The leadership, I always say this, it's important to focus on what the leadership is saying, not what some of the backbenchers who might talk more often are saying. That's what a decade in Washington taught me. Now, Jay Powell has firmly anchored his view that, look, there will be interest rate cuts this year, more than likely. It's a projection, not a promise. It also means they don't have to rush. Now, there's been a lot of focus on this reacceleration, for want of a better term, that we're seeing in US economic activity. These rapid hikes that have preoccupied us for the past couple of years don't seem to have slowed growth down that much. However, look, let's not forget where we've been with inflation. PCE, the inflation measure that the Fed bases its 2% target on, has come down dramatically from where we were in 2022. At one point in 2022, PCE was above 7%. It's now 2.5%. So, you know, you're also probably going to hear a lot of talk about the last mile being the hardest and so forth. But we just need to see a continuation of numbers like this. They don't have to necessarily be better. And remember, it's an average of 2% over time.
OK. So it seems clear, at least, that the US isn't in a rush to cut rates. And yet, for the ECB, a June cut looks pretty much nailed on to many at this point. So with this divergence, what about the weaker euro feeding into the European inflation story?
Yeah, what's transpiring at the ECB is much more clear-cut. And the communication has been much less vague. You know, even the Austrians, who typically like hard money, recognise that the economy is not in great shape and that inflation has come down markedly. You know, my Bloomberg Opinion colleague, Marcus Ashworth, asked a pretty pertinent question last week, which is, if you're all talking about June and the press conference that Christine Lagarde gives is going to be all about June, why not just do it now? It's a good question. Economically, you're not going to see a lot of change between now and the June meeting. You know, there is a case for just getting ahead of the narrative and doing it in June, doing it in May, excuse me. That would be impressive.
Indeed.
I would love to see that.
Are they just hiding behind those jobs numbers? Why not just do it now? Bloomberg's Dan Moss daring Christine Lagarde to go ahead this week. We thank you for that analysis. Now, as I say, it's a busy week. We have already just talked about US CPI. That's coming on Wednesday. Of course, it is a crucial piece of the data puzzle for the Fed. And economists are expecting a modest slowdown in core inflation, even if headline inflation stays around 3% towards the end of the year. Super core inflation, of course, has been really sticky here. We were just talking with Dan about Thursday's ECB rate decision in Frankfurt, a June cut seeming pretty much a done deal now, so the focus very much on clues as to the path beyond that and therefore how much divergence there'll be from the Fed's own rate cutting trajectory. Then on Friday, from the Bank of England, get former Fed Chair Ben Bernanke's review of forecasting, and the expectation is that whatever the recommendations are, likely a move from fan charts to Riksbank-style scenarios, it's going to take a while to be implemented. And even when they are, they're more likely to affect the Bank of England's communications than how it makes policy. But we'll wait to hear the specifics from Bernanke and co. on Friday. But you can get a roundup of the stories that you need to know to get your day going by going to DAYB Go on the terminal. That'll take you to today's edition of the Daybreak newsletter. They're leading on China this morning and also a story on Elon Musk for you to check out. But coming up later in the programme, Zimbabwe replaces its battered dollar with a new currency backed by foreign currencies and gold. We'll bring you that story next, as well as an interview with HSBC. It's looking to bolster its wealth management business in China and India. We'll hear more from that exclusive interview with CEO Noel Quinn at 6:30 a.m. London time. So stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. It's 6:17 a.m. in London, and we're going to head to Africa now, where Zimbabwe is replacing its battered dollar with a new unit called ZIG, which will be backed by a basket of foreign currencies, gold and other precious metals. The sweeping move is Zimbabwe's sixth attempt to have a functional currency since 2008. Joining me now for more is Bloomberg's Ondiro Oganga. Ondiro, just talk us about this transition to the new currency.
Lizzy, it has been a long time coming, judging from the current state of the Zimbabwean economy. Inflation is high, their currency is battered, prices of goods and services have skyrocketed. If we zoom in on their currency, the Zimbabwean dollar, it has lost nearly 75% of its value to the dollar this year alone. And that's why the central bank made this decision that was awaited with bated breath. Now we have a new currency, the ZIG, that is backed by gold and other foreign currencies. And the central bank says they have reserves of up to $285 million. So what's happening currently is banks and other financial institutions are recalibrating their systems and rebasing their current balances. And the central bank governor, who assumed his role a month earlier than expected, says that a couple of changes will be coming. And part of these changes is, one, to ensure that the Zimbabwean currency does not die, but also to stabilize it so that they can have some stability in the prices of goods and services.
And just talk us through some of the other key decisions the central bank's been making and their expected impact on Ondiro.
First of all, he has cut rates from a high of 130% to 20%. This was the highest rate in the world, but wasn't the highest in Zimbabwe. We've seen highs of 200%, which makes lending extremely hard and makes it harder for the private sector to borrow, invest, and even grow. Other changes will also include all businesses required to pay taxes by at least 50% using the local currency to inject some form of transactionability into their currency. Because if you look at the Zimbabwean dollar, which is being phased out right now, it's only used for 20%, which is to pay utilities and smaller transactions. Majority of the transactions are done using the US dollar. And because of these changes, the central bank is anticipating that inflation might ease to about 2 to 5% by the end of the year from a high of 55%. The goal here is to inspire confidence in the market and in the people. But that's an uphill task. And until they do that, this is just another currency transition from Zimbabwe, like they did with the gold coins, the digital tokens, and slashing a couple of zeros from their previous currencies.
OK, Bloomberg's Ondiro Oganga, we thank you in Kigali with that outlook for Zimbabwe's new currency, the ZIG. Now, I also want to just take a check on commodities because it was a week for commods last week. We have had the confluence of geopolitical risk, high demand and supply side issues affecting oil. So Brent currently trading just shy of $90 a barrel. I mean, Amrita Sen really emphasising that it's the supply side that's the biggest driver here. But in terms of geopolitical risk, of course, you have had tensions between Israel and Iran fluctuating. Just think, though, we were at a level of $72 a barrel in December. 90 is a level that OPEC Plus is likely to want to maintain, around which the price can fluctuate, as it inevitably will, because if it heads back towards $100 a barrel, as Goldman says it could, that would perhaps fuel inflation and hurt demand. So you might say 90 is the sweet spot that powers an economic recovery, and the question being, can they maintain it? So Brent just shy of $90 a barrel. You've got WTI at $85.68 currently, and gold at a new high, despite the equity rebound off the jobs report on Friday. As Tanya Chen says, you've got some tailwinds coming in from China as well. Which brings me on finally to iron ore. It's rebounded back above $100 a tonne on this speculation that demand from China could pick up. China, of course, the world's biggest steel maker, and you've got traders back after the long weekend giving a boost to the commodity. We've got plenty more still ahead for you, so stay with us. This is Bloomberg. Now, the AI-driven boom in demand for high-bandwidth memory has helped drive a 400% share surge for a Japanese firm that controls an essential part of the chip-making process. The CEO of Tower told us exclusively how the company plans to further strengthen its position.
What's most important is that we have technology that other companies do not have. We are in charge of the chip sealing process. There are two major methods of sealing: transfer and compression molding methods. Transfer molding is a common method, but the compression method is required for high-end chips, and we developed the first model of this technology in 2009. Even after 16 years, we see no competitors in this technology.
You currently own this market. You create about 60% of the world's chip sealing machines. Do you have any plans to further that market share?
We develop products based on the concept of how much customers appreciate and like TOA. By specializing in high-end products, we can naturally link this to a large contribution to profits. I think this is the most important point. We had a strong desire to have 100% control of the molding process, but we've seen the emergence of many local Chinese manufacturers that produce low-priced products. This leads to price competition, and this will greatly squeeze profits. If we want to make money, we need to focus on the high-end market, where there's no competition. We should specialize in this area and expand these markets. We occupy more than 90%, and we want to maintain this top position globally.
There's huge demand for AI chips globally right now. What's your plan to increase output going forward?
We have been working towards a 10-year vision of achieving 100 billion yen of sales by 2032. Currently, our production capacity is at about 70 to 75 billion yen. We would like to start building a structure in the next fiscal year to achieve our goal of 100 billion yen of sales by 2032.
Your shares are up 4x over the past year. Do you see this as a good opportunity to capitalize on those stock gains, potentially maybe investing in boosting production?
We are very grateful and happy about this. A rise in the stock price equals a large increase in market capitalization. We need to make a considerable investment in order to achieve our next dream of 100 billion yen in sales. I believe the stock price has made it easier for us to do so in many ways, and I am truly grateful for that.
How about M&A? Which sectors and regions look attractive to you, and how much would you want to invest?
If both parties do not achieve a win-win situation, it cannot be an M&A in the true sense. In any opportunity in the future, we will always focus on this.
You inked a deal with a major South Korean chip maker. Do you expect your Korea business to eventually be as big as your sales in China are currently?
Especially in AI devices, we expect SK hynix and Samsung to make a large investment in the future. And we believe that the market will continue to grow. But the Chinese market is still very large, and I think it adds a different dimension. China has its own way of doing things, and Korea's Samsung and SK hynix have their own original ways of doing things. So we're not thinking of them in the same way.
What is the one thing you think Japan needs most when it comes to staying ahead in the world?
I believe that the basis of a manufacturing company is to develop products that are unrivaled by other companies, products that will surprise other companies, and products that will please customers. We would like to expand our business based on this concept.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzy Burden in London, and these are the stories that set your agenda. Asian stocks start the week with gains, while European futures trade broadly flat as traders stand by for Wednesday's data on US inflation. Meanwhile, Israel says it's pulling some troops from southern Gaza ahead of a planned offensive in Rafah. The oil rally takes a breather. Plus, US Treasury Secretary Janet Yellen meets the PBOC governor on her last day in China as she aims to put relations with Beijing on a firmer footing. Those are your headlines. A very good morning. Welcome to a new week. And to explain what's happening markets, I'm going to take you right back to Friday. That blockbuster US jobs report, really markets interpreting it as good news this time. Good news on the strong economy that could power corporate America, even if the price is rates higher for longer. You've got stock futures pointing to a slightly lower opening stateside this morning, but higher for the European futures. And if we flip the board over to the cross-asset picture, you can see the impact of that jobs report on Treasury. So you had a bit of a repricing. Now traders seeing about 65 basis points of rate cuts from the Fed towards the end of the year. And then you've seen Treasuries off the back ticking lower. So currently the 2-year Treasury yield higher 3 basis points at 4.77%. The dollar is a touch stronger. And if you look to oil there, Brent trading at $89.76 a barrel. This is on the geopolitics and Israel pulling out some of its troops from Gaza, or saying that it will. Just finally, a look to Bitcoin there, lower than the 70K mark that it managed to pass over the weekend. But we can now dig into what's happening in Asia markets. We've got Tanya Chen in Hong Kong for us. Tanya, what's happening where you are?
Hey, good morning, Lizzie. Yeah, so as you were just saying, the market kind of exuberant over the possibility of this no landing scenario. So we're taking a look at kind of benchmark equities across Japan, Australia, South Korea, all ticking higher, starting the week off quite strong. You also want to kind of turn to onshore mainland Chinese stocks and Hong Kong. They're not quite as exuberant as we're seeing in the other kind of Asian regional stocks. We're getting some news out of the property developer space today. One of the defaulted developers, Shimao, is facing a demand to liquidate. These winding up petitions are really starting to pile on. We've seen it with Country Garden as well. So that's sort of kind of taking a hit on the stock side here. Also on the board, we're looking at commodities. We're looking at gold. As you had mentioned, gold is also kind of on a tear recently, obviously around these expectations around these potential U.S. interest rate cuts. We're also seeing these central banks out of China and India buying quite a lot recently and kind of driving up that price. Chinese central bank has been buying for 17 months straight. And also with the Chinese central bank today on the currency front, you had mentioned the dollar a touch higher. Yes, regional Asian currencies are definitely under pressure. Almost all of them near their year-to-date lows. On the yuan in particular, traders have been eyeing this fixing level where the central bank officials basically set where the onshore rate can trade in a 2% trading band. And today they've kept it roughly just below 7.1, which means that if you look at the onshore rate now, it's already kind of nearer to that weak end of the trading band, implying that there's a lot of depreciation pressure that's building. So we'll basically wait and see for the next few days what this means from the policymakers, if they'll take more forceful measures to defend the currency.
OK, Tanya Chen in Hong Kong, we thank you. And we're going to stay in Asia now because HSBC CEO Noel Quinn says he's pushing to improve his bank's wealth management capabilities in China and India so they're just as strong as in its home market. He was speaking exclusively to Bloomberg's David Ingles earlier as the bank hosts its first global investment summit in Hong Kong.
In 2023, the performance of our wealth and personal banking business here in Hong Kong, we saw significant customer acquisition growth.
Right.
We also saw around about a 50% growth in our insurance and wealth business in terms of the new business they were writing last year. So the facts are wealth management is continuing to develop and grow here in Hong Kong. The liquidity base here in Hong Kong today is higher than pre-COVID levels. So I still see Hong Kong as a vibrant financial centre. Capital markets are subdued at the moment, but that's a function of still coming out of COVID, economies waiting to recover. What will inflation and interest rates do?
Right.
But we're seeing some early signs of the debt capital markets starting to pick up as well. So the facts, I think, support the fact that Hong Kong still is a vibrant financial market.
Right. Now, I know you're set to report your first quarter earnings in a couple of weeks, so you can't
Yeah.
get into the details as well. But we just wrapped up, of course, the calendar quarter.
Yeah.
If you could also indulge us, how do you think the quarter went for you guys, generally speaking?
Well, 2023 went extremely well, over $30 billion of profit, a record profit. And that's a culmination of the hard work of our colleagues over the past 4.5 years, and also the loyalty of our customers. They've been very supportive of HSBC as we went through COVID and transition. Our returns were the best for over 10 years, and our dividend at 61 cents was the best dividend for 15 years. So I was really pleased with the performance. We're never complacent. We're making sure that we're well positioned for the future, and we're continuing to invest in the business. We're investing in wealth management here in Asia. We've done a number of acquisitions to do that.
Right.
The most recent one that we announced was the acquisition of the Citibank wealth management business in mainland China. We bought an insurance business off AXA in Singapore,
Right.
and we bought an asset management business in India. And again, just to put it into context, every region performed well last year, and every business line. In India, we made over $1.5 billion profit. If you put BoCom and our own shareholding of our own bank in China, we made over $3.5 billion profit.
Right.
So, well-distributed profit across the world, and all parts of the bank doing extremely well.
We've done some reporting on your plans around your assets in Germany. I was wondering if you could comment on what your plans are for those assets.
We remain absolutely committed to being an international wholesale bank across all of Europe, including in Germany. So there's no change to that.
Okay. So those are not for sale?
Those are not for sale. We have some business lines in Germany
Okay.
that are non-essential to international wholesale banking.
Understood.
And we're considering options for those, and that's what the rumor and the speculation was.
Right.
But that is not about our international wholesale banking proposition or,
Right.
or corporate banking proposition in Germany.
Thank you for clarifying. Assets in Russia, I know the bank has also been looking at that. If you could give us an update on whether those are actually up for sale and when you want those.
Well, we
Or
have
you have a price tag for them.
we have regulatory approval to sell that business. We're
Yeah.
going through the final stages of trying to close that transaction, but it is our intention to sell the business. We have regulatory approval on it, and we're in the process of trying to close that transaction.
HSBC CEO Noel Quinn there speaking to us exclusively at the bank's Global Investment Summit in Hong Kong. Now to central banks, the week's shaping up to be another busy one for traders, with the pivotal US CPI data looming, and then less than 24 hours later, a rate decision from the ECB in Frankfurt. Joining me now to take us through all of that is Bloomberg's Ruth Carson. Ruth, how are investors trading the dollar with risk events like this looming?
Yeah, absolutely. It's been rough for currency traders, especially if you've come into 2024 as a dollar bear, which, by the way, was the prevailing position at the end of last year. Instead, investors who've bought the dollar have done incredibly well, be it against the euro, the Swiss franc, the Aussie, the yen. And with US data continuing to surprise on the upside, it will take a very brave person to go all in on shorting the dollar, even though it is expensive by historical standards. Now, US CPI, as you rightly mentioned, could be another clincher for dollar strength on Wednesday. So if we get another blockbuster number, we could see the dollar getting a very strong bid, and the traditional risk proxies, the Aussie, the yuan, the Kiwi, all taking hit. Now the yen, which is at a 34-year low, near a 34-year low, could also be sold on the whole rate differential story if the Fed is expected to keep rates higher for longer.
I'm going to be brave now, Ruth, and say it seems inevitable now that the ECB is going to cut before the Fed. How much could that knock the euro and then feed back into inflation?
Absolutely. So traders could be eyeing a double whammy there as well for the euro. So you got US CPI, then in less than 24 hours, you've got the ECB. And yes, there is, a chorus of doves out there. And when you look at where currency markets are at the moment, the euro is down about 2% versus the dollar so far this year. It is still the second best performer, though. So the question then is this: if traders are already worried about higher for longer rates in the US, what will happen to the euro if indeed the ECB does cut more than expected or cut first? So a decoupling of the ECB and the Fed's rate path could mean a weaker euro. Bank of America, for example, has already come out to say that it could weaken to parity against the dollar should the Fed stand pat on rates.
OK, so that's the impact of the Fed lagging perhaps here in Europe. But then, as you say, we've got CPI coming this week on Wednesday. Is 4.5% the next big test for bond traders looking for opportunity?
They certainly don't get any rest, do they, these macro traders? 4.5%, we have to remember that markets absolutely love the big, bold numbers. Is it the next line in the sand? Certainly looks that way. US CPI could be the next catalyst to see whether yields will stabilize, drop, or shoot higher. At around 4.4% currently. It could test 4.5 if the numbers do come up stronger than expected. Now, if we look at BYFC, which is the bond yield forecast function on the terminal, bond yields are expected at the 10-year mark to fall to under 3.9% by year end as the Fed cuts rates. So if that's the case, investors may be looking at these levels as a good time to get in. But 4.5, certainly a big number to watch out for.
All right, Bloomberg's Ruth Carson, we thank you for that look ahead to a busy week on the macro front. And just staying on the story of central banks, of course, on Friday, it's a big day right here in the UK for the Bank of England because we're going to get the conclusion to Ben Bernanke, the ex-Fed chair's report on BoE forecasting. We've had to wait a while for it, but it's really likely to be an interesting one. The Governor of the Bank of England, Andrew Bailey's already hinted that it's going to involve retiring the BoE's fan charts that are currently used to show the range of possible economic outcomes on different variables. Of course, here in the UK, we don't have a dot plot, unlike the Fed, though I don't know what you call all this talk of mountains recently. Seems like a dot plot to me. Nonetheless, it seems like the fan charts are going to be replaced with scenario models. So like the Riksbank uses, this is the sort of situation where you have, if the economy does X, rates would do Y. But whatever they do, it's going to take a while to implement them. We're waiting for the new Deputy Governor, Claire Lombardelli, to take her seat on the Monetary Policy Committee. She's expected to take charge of implementing these changes, and she doesn't join the MPC until later on this year. But another big question for the report is whether the Bank of England is going to continue to use the market path for interest rates as the conditioning assumption for its forecast. You'll remember back in November 2022, it created really quite a lot of confusion for saying that there'll be a recession, but that recession was conditioned on rates following the market path, which the bank didn't endorse. Very confusing, managed even to confuse the UK newspapers. So perhaps Ben Bernanke clearing up the Bank of England's forecasting and communications this week. So we await that report on Friday, but coming up in the programme, we'll go to India. India vying to take China's global growth engine crown as foreign investment floods into the country. That's our big take, and it's coming up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. To India now, where the Nifty 50 is higher 0.5% this morning. If we just take a look at why, look, this is already an overvalued market, but it's summertime in India and the heat has been powering shares of aircon makers, power generators. But that heat also is bringing risk for the market there. You've got water shortages and crop damage, potentially keeping food prices elevated and pushing back the Reserve Bank of India's rate cut. You could also see a spike in energy demand exacerbating power shortages. But as I say, for the day, the Nifty 50 higher 0.5%. But this is really the subject of today's big take on the terminal, a broader look at the future of the Indian economy. India really vying to take China's crown as the engine of global growth. And it says foreign investment floods the nation and its government lines up a number of new trade deals. Well, we can get more on that big take with Bloomberg's Dan Strumpf, who's in New Delhi for us. Dan, welcome to the programme. What are the obstacles to India becoming the world's driver of economic growth?
So there are a number of obstacles for India right now. Some of the biggest ones are India needs to develop its infrastructure. It needs to urbanize its economy. And it needs to attract foreign investment. And it's working on all of these things. Narendra Modi has made a priority of of investing huge sums of money in infrastructure. Of course, foreign companies are flocking to India, and every global company around the world right now has an India strategy of some kind as they pivot away from China and look to diversify their supply chains. But there are a lot of obstacles ahead for India. I mean, growth is really not where it needs to be right now. Many economists say for India to sort of really capture the growth crown from China, it needs to get economic growth up to around 8%, even 9% or higher. And these are levels that, of course, China enjoyed for much of its recent history. And India is not quite there yet. The government right now is targeting around 7% for growth. If you sort of peel back the curtain there a little bit, the current growth rate is really around 6% or so. So India, of course, has a lot of promise. A lot of investors are turning there, but still some obstacles that need to be overcome.
And if India does manage to overtake China, what's the significance of that apart from boosting Modi's ego?
Yeah, well, it's a great question. Of course, that is one major outcome that you'll get from it. Of course, and this is hugely important right now as voting gets underway in India in just a couple of weeks. But more significantly, and this was really the issue we tried to explore in our story today, is what happens if India overtakes the growth crown. Now, you just have to look at China as an example for what it means. Now, China has, for the last several decades, largely been the driver of global economic growth, been the incremental contributor to the bulk of the world's growth. Now, what did that mean? It meant that global investors all flocked to China. It meant that China was the driver of capital markets activity. It meant that China was the magnet for foreign investors and foreign multinational companies looking for growth, looking to participate in that market. For a long time, China, we all sort of operated under this assumption that China was going to continue to have that, to carry that mantle. And we now see, since the end of the pandemic, that China has really struggled to produce that growth. And now there's many eyes on India to see if India can be that next driver for growth.
OK, really exciting. The subject of our big take, do give it a read. Bloomberg's Dan Strumpf, we thank you. We've got plenty more ahead. Stay with us. This is Bloomberg.
This was a hot report. Jobs above 300,000, upwards revision, strong household survey, hours up, payrolls up at nearly a 10% annualized rate. This was a hot report that suggested that, if anything, the economy is re-accelerating. This is very different from what most people, I think, were expecting, and fits the thesis that the neutral rate is much higher than people supposed, and tight money is much less potent than people supposed.
So let's talk about the neutral rate. You've said before that the Fed should have at least some idea of the neutral rate to know whether it's restrictive or not. We heard from Chair Powell this week, speaking at Stanford, where he said, yes, we are restrictive in our policy, and yet he quite explicitly said he doesn't need to worry about where the neutral rate is for policy going forward.
That is like saying we don't need to know what the neutral rate is like saying you should drive your car on feel without looking at the speedometer. It is just a mistake. You cannot know, and look, I don't know what the chairman said in full context, and I want to be fair, but there's no way to judge what policy is without knowing what would be a neutral policy. My view is that the evidence is overwhelming that the neutral rate is far higher than the 2.5%, 2.6% that the Fed talks about. That evidence comes from four places. First, we have high interest rates, and we have an economy that is, if anything, growing faster than its long-run potential, creating jobs as fast or faster than natural growth in the labor force, even allowing for immigration. Second, we have an economy with financial conditions that are extremely loose, that are actually looser than they were before the Fed started the whole tightening process. If you look at credit spreads, you look at the stock market, suggesting that in the fullness of it all, financial conditions actually haven't been tightened in an appreciable way. Third, if you look at the market's estimate of the long-run neutral rate as formed by looking at longer-term forward interest rates, that neutral rate is comfortably above 4%. Fourth, if you look at the fundamental determinants of the neutral rate, we have big surges in budget deficits that, if anything, look to get worse given the political process. We have big changes in resilience investment, in green investment, in new investment, in data centers, along with deglobalization, which may limit capital inflows into our country. So whether you look at the fundamentals, you look at market estimates, you look at financial conditions, or you look at the current strength of the economy, it seems to me the evidence is overwhelming that the neutral rate is far higher than the Fed supposes.
So that was former US Treasury Secretary Larry Summers speaking with David Weston following that hot US jobs report, which we can dive in a little more deeply into now. It brings us back to my conversation, eagle-eyed viewers will remember, with the Morgan Stanley chief US economist Ellen Zentner on Friday. She was talking about immigration specifically and the impact on the labour market. Now, the Fed Chair Jay Powell has said that because of immigration, you've got a bigger economy, not a tighter one. And this was well illustrated in the jobs numbers. Look at the white line, the number of foreign-born workers compared to the domestic-born workers, the blue line here, and that crocodile mouth opening out. The point being that immigration boosts the break-even rate, how fast payrolls can grow without tightening the labour market, and therefore stoking wage pressure. So we very much saw this. If we flip the board, you can see the impact on the stock market on Friday. The S&P taking this finally as good economic news, good for the market as well. A strong economy expected to power corporate America, even if it means rates higher for longer. I'm sure they'll be discussing this up next on Markets Today. You've got Anna Edwards and Guy Johnson up next. This is Bloomberg.